So if you study this period from 2009 onwards to roughly 2013, right? So if we do a very quick math here, what you will see is that the stock used to trade at roughly 1400 and it went all the way to 5300. So it almost 3x'd in price over a period of 4-5 years. So you would have often heard that India is a growing country, our population is young, hungry, we consume a lot, India is a consumer driven economy. But here is an interesting data point that was tweeted by Mr. Kunal Shah. So what he said was that, hey, if you take away top 3 crore customers in India, then our per capita GDP falls from USD 1900 to USD 600. Just to help you contextualize that number more, if the top 2.5% of our population is taken away, then the remainder of the population only makes 125 rupees a day. That is how bad the situation is. Now, why am I talking about this data figure? Because many of the startups, many of the companies, they enter India thinking that, you know what, we will be able to cater to so many people. Might be the case and it can be useful for you as a company, no doubt about that. But there are very few industries and companies that are able to truly cater to entire India profitably. That is the most important point. So on today's video, I'm going to speak about one such industry, which I feel is catering to the entire India and it will continue to cater to entire India. And I'm going to pick and analyze one of my favorite stocks from that industry. I feel that it is a great stock to buy and hold, but this is not an investment advice. Please do your due diligence because I can't predict short-term stock market. But yes, from a long-term perspective, I feel that it is a very good share to hold. And also a disclaimer, I'm already a shareholder in this company and I have shown several live investments on my videos in this particular company. And this is not Hindustan Unilever. Okay, so let us understand the story in 3 parts. One, we will talk about the industry overview and why I feel this industry is likely to grow. So which industry am I talking about? I'm talking about FMCG industry. Second, I'm going to do a fundamental stock analysis. And then finally, I'm going to talk about why now might be a decent time to buy this stock, especially when the stock dips, and I'll talk about some technical patterns that are forming. So let us get the analysis started. First and foremost, take a look at this particular chart and what you will notice is that the FMCG industry has been growing at a relatively decent pace. It is considered to be a stable industry. There is no fundamental problem. These are products that we use every day. Companies like HUL, Kolpal, some retailers like DMart can also be clubbed into FMCG industry. Important point to notice that this industry was growing at a massive pace till 2020. There was no problem there. And several other industries were also growing up to that point. So which brings me to the unique aspect of FMCG industry. And this can be illustrated through this chart. And you will see that the growth rate of this industry in rural economy was strong. This is the most important aspect of it because the data point that I talked about earlier that, hey, take away like top 3% of India's population, the numbers fall quite aggressively for GDP per capita. Now, this particular chart talks about that particular population, that FMCG industry. If you take a look at the bottom 30%, even there, this industry is growing. And it is one of the very few industries to exhibit such a growth in that particular segment. Now, please note that this data is till 2018. In 2019, 2020 also there was growth. I was not able to collect the complete data, but after 2020, the situation has changed because the rural demand entirely has gone down. So you need to ask yourself a simple question at this stage that, hey, going forward, do you see these two trends picking up? That, hey, overall industry is going to grow, that people are going to consume more FMCG products. And number two, and more importantly, would this customer segment continue to engage with FMCG based businesses? The answer, according to me, to both these things is a strong yes. And there is a very simple concept around here, which is called as the elasticity of demand. So elasticity of demand simply means that how flexible are you with switching to a different product. Consider, for example, that you are buying pizzas. Now, pizzas to many would be critical products. So let's say that right now you buy a pizza and it roughly costs you 350 rupees. You order from Zomato, Swiggy every day because you love eating pizza. Now, let's imagine a world that suddenly the pizza prices goes to 1000 rupees. Now, will you continue to order it from Zomato, Swiggy? The answer most likely will be a no. You might switch to eating like curd rice or chole bhature, whatever it is, right? So bottom line is that some products have high elasticity of demand, for example, pizza or things that can be substituted easily. And some other products, for example, smoking cigarettes. Now, cigarettes are extremely inelastic when it comes to demand. No matter what the price of cigarette is, people would usually continue to smoke cigarette. Of course, there will be a little bit of fall. There is no such thing as perfect inelasticity, but I hope you get the point. So just to draw it out on the spectrum so that this difference between elastic and inelastic demand based products become clear, FMCG products will be placed somewhere towards the inelastic side. So this is the primary advantage of FMCG products, that when when it comes to products like toothpaste, toothbrush, etc., the demand is not that flexible or elastic. So this is the key point that you need to remember. And let us look at some of the key value drivers in this particular industry. So value driver simply means that, hey, what moves the needle in this particular industry? So you might have seen several investors like Mr. Saurabh Mukherjea expanding upon the viewpoint. And in case you have not checked my video with Mr. Saurabh Mukherjea, I'll link it down in the comment box. Please go and watch it. It was a very insightful chat. Okay, so coming back to the topic, that many industries are moving from unorganized sector to organized sector, and India has a very large unorganized sector. So as this change accelerates, more and more companies are going to become big and market leaders are going to become stronger. I agree with this point, but with a small caveat. So the word of the day today is caveat, and let me know what does that mean. So this change is true that it is coming and India is getting more and more organized, but this change impacts different industries differently. So let us pick two examples. One is EdTech and one is FMCG. So let's pick names also, right? So let's pick Byju's and Nestle, the stock that I'm going to talk about today. So if we are comparing Byju's, it is an EdTech. So what is it is trying to do? You will say sales, and I will agree with you, no doubt about that. But if you look at it at the broader viewpoint, what they are simply trying to do is that they are trying to again play this game of unorganized to organized. Tuition market or coaching market was highly fragmented. You used to go to your math teacher, English teacher, etc. And Byju's is trying to sell you everything by bringing all these teachers onto their platform, or one way or the other taking business away from them. So they are simply trying to play this game from here to here. Now compare this example with FMCG also. Now what is HUL, Nestle, etc. trying to do? Again, they are trying to take away market share from small shampoo manufacturers or local manufacturers of, let's say, honey or coffee, etc. Right? So that is what HUL and FMCG are also trying to do. But the landscape is completely different when you look at different industries. Think about it this way, that when you go and make a decision to put your son or daughter into a particular education program. For example, if your son or daughter wants like math tuitions, or if your younger brother or sister wants some kind of math tuition, then you will probably go check so many reviews of who can teach math best in your city. Now, whether that person is working with Byju's or not Byju's, you will not get impacted by it, because your goal would be to send your son or daughter to the best possible math teacher you can find. Now, you don't really care, or in an ideal world, you should not be caring too much about that. Hey, you know what, whether that person is associated with Byju's or XYZ company, it doesn't matter at all, right? So you would just find the best teacher and send them there. But that is not the case when it comes to FMCG product. Again, do a thought exercise. For example, if you go and buy a toothpaste, if you see a very local brand, you might get suspicious that, you know what, is it even going to be healthy? Does it have too much sugar? There might be some issues at it. Brand is not there. Clean packaging is not there. Bunch of 100 different things. So a FMCG based monopoly can continue to play this game from unorganized to organized. But when it comes to EdTech, I don't think this monopoly system is going to work for too long. It is really difficult because people want to learn from individual content creators, individual teachers, etc. So yes, you can do a lot of push-based selling. You can create like an 80-90% sales force, throw a lot of money, but at the end of the day, people will still discover good teachers and send their kids to them. So it is extremely hard to play this unorganized to organized sector game in the EdTech, but not that complicated in FMCG. So I hope this short discussion helped you understand this entire unorganized to organized sector game. Now with that viewpoint in mind, big FMCG firms have three key advantages. So the first advantage is that they can undertake a lot of customer research. For example, Nestle, HUL, bunch of other top FMCG companies, they have the money to send their teams to different villages across different geographies in India, generate customer insights, figure out what type of packaging they like, what type of products they like. So this customer research becomes a very important tool to customize local products accordingly. You might have seen that a lot of shrinkflation has taken place. Shrinkflation simply means the decrease of the size of the packet of different products. So you would not even realize it. It would appear that you're still buying like a 10 rupee Cadbury, right? But the quantity that you're getting, it is getting shrinked. So that is shrinkflation. These are some of the insights that could be generated through a concept called as human-centered design research techniques. I had used these techniques extensively when I was working in management consulting. So the bottom line is that this customer research data is very, very important, and it becomes a winning tool for these big FMCG based businesses. The second key thing or second key advantage is the distribution network that they control. Again, think about it this way, that if you are an EdTech teacher, for example, me, I run a website called as Wisdom Hatch. You can go and check it out. And you are watching this video, so probably you might go check out Wisdom Hatch, that what kind of courses is Akshat running. So this is distribution for me, so to say. Now, with more democracy in terms of internet, creating distribution in edtech has become easier. So therefore, I don't need to go to big players to sell my courses per se. If I have to do it, if people like the quality of the product, if people have trust, faith, and if they like my teaching style, then I'm sure that they will check out my courses from that viewpoint. So that is the simple reason why the entire distribution is not controlled by big edtech monopolies, so to say. Even small players like me can thrive if we are providing quality content. So that is my belief. I can be wrong, no doubt about that, but that is my viewpoint. Now compare this with FMCG space. Now who are the distributors and retailers in FMCG segment? They are small shop owners in villages. They are like, mid stores, mom and pop shops, etc., etc. What do they ask? They simply say that, what, can you give us maybe like 10% commission? We will sell your product. So HUL or Nestle will say that, okay, cool, take it, no problem. Why? Because they have margins. So they are able to do it. But if I, as a manufacturer of local shampoo, try to make my brand available all across India, then again, I'll have to get into all these negotiations with different distributors, retailers, and my margins will be crushed because I do not have this third point, which is called as optimization. So optimization simply means that all these big brands like Nestle, HUL, they continuously keep on improving their margins. I will show you from the financial data also, how are they able to continuously improve their margins? Because once they gain scale, they start negotiating those contracts very efficiently. Plus, they optimize their manufacturing, they optimize the size of the factory, they optimize their distribution network, they open their own stores, bunch of different things. So I hope you are able to relate to this point that a lot of people got worried that, HUL fell by this percent, that percent. I kept on stating the fact that, hey, HUL is a great stock. And let me show you data for both HUL and Nestle right now. And let us do a very quick computation and analysis. So let us take a look at 6-month fall of HUL. It is minus 2.75%. Okay. So now let us take a look at the Nifty fall or the entire market fall. So last 6 months, we have been crushed by more than 6.5%, right? So that is point number one. So of course, this data point might not be relevant for all FMCG stocks all the time. But the point that I'm trying to drive home is that FMCG stocks are relatively safer. That's the key message that I'm trying to give out. So if you hold these stocks for a slightly long-term period and keep accumulating them when they are in a dip mode, you will be able to build a very strong portfolio. So with that said, let us start the fundamental analysis of Nestle and let me show you some key points about the company. So first and foremost, let me delve deeper into the point about profit margin. So you can clearly see that if you take a look at the last 10-year window, just look at the operating profit margin growth. So on an average, it has been growing, right? So there is absolutely no problem. Even in 2020, 2021, their profit margins have been preserved. Yes, sales might have taken a hit. All those structural changes might have taken a hit. Supply chain inflation, this, that, all that stuff. But have they lost their profit margins? No, absolutely not. And what do you think is going to happen in the next 5-10 years? Is this profit margin going to become 26-27%? The answer most likely is a yes, irrespective of the economic conditions. Will the stock price grow proportionally? We don't know. We can't predict it. But at least it points to the dynamics of having a strong business. Now, let me show you second magical thing which will impress you about this stock. So if you study this period from 2009 onwards to roughly 2013, right? So if we do a very quick math here, what you will see is that the stock used to trade at roughly 1400 and it went all the way to 5300. So it almost 3x'd in price over a period of 4-5 years. Now let me compare this example to Nifty. So we were sitting at Nifty at approximately 2800, 2900, even at the bottommost point. And what happened till 2013, 2014? It did not even go 2x from that point. So the point that I'm trying to drive home is fairly simple, that even in bad economic situations, FMCG stocks are stable stocks to build some positions in. Again, not an investment advice. Please do your own due diligence analysis. Please take my inputs as a simple data point. Now, if you study Nestle in particular, you will notice some of the key trends that, for example, it has roughly 63% market share in chocolate segment, 70% in condensed milk, 96% in baby formula, 51% in instant coffee. What are these? These are almost monopoly-like segments that Nestle has already captured. What will happen maybe 5, 10 years, 15 years down the line? Do you think that their margins are going to get cut? The answer is no. Why? Again, go back to the 3 reasons that I was speaking earlier. There is no way that these companies will lose their profit margins. They have insane money. They can do insane amount of customer research and they can literally capture distribution channels, which small players can't. It's very, very difficult for small players to create a large scale impact. Yes, every now and then you will have like some firm popping up here and there, and they can take away a little bit of market share, so to say, but on a sustained basis, it is very, very difficult to do. Now, before moving on to the technical analysis side of Nestle, let me give you a very quick commentary as to what the critics of FMCG companies are saying. They are saying that, you know what? COVID happened, so much supply chain disruption, these stocks have fallen down, they will never come back up, people will stop buying this and that, prices have been so high, rural demand has gone away, all that stuff. Okay, that is just one part of the equation, and that is just half the picture. I will explain you why. Right, so take a look at a couple of key points from the recent 2020 and 2022 crisis. Two things have happened. One is inflation has gone wacky. I have already made a lot of videos on that. And the second thing is the supply chain disruption. And supply chain disruption is really hurting FMCG companies, and they have fallen quite a lot, no doubt about that, because of supply chain disruption more. So this is a key problem. I am not arguing about it. So I had to sit and read the entire report as to what type of systems and processes these big companies are undertaking, which will help them not only now, but also in the future. So here is a very important snippet from their annual report that your company, which is Nestle, has increased usage of bigger size vehicles from 5.9% to 9.8%. They have increased usage of railways from 8.2% to this and this. Similarly, they have undertaken a lot of cost optimization exercises, what type of container to use, what logistic support can be used, how to optimize for that, bunch of different things. Now, do you think that they are optimizing their cost now? If they get benefits out of it, which they already are they going to discontinue it when the situation improves? The answer is no. They have already figured out a great model now which works from them, and that is how their profit margins will go up from 24-25% to 26-27% very, very quickly. Because these type of systemic changes in the ecosystem becomes an opportunity for these big companies to innovate, and they can actually research about these changes and improve their overall logistics, manufacturing, and bunch of other dynamics. Similarly, if you think from a long-term perspective, this is a very, very important development that is happening in the FMCG space, that enhancing digital first with human touch becomes very, very important for FMCG companies in the future. This came out in a McKinsey report also, and they are undertaking a range of things to already prepare for this long-term change. So whenever this long-term change happens, companies like Nestle, HUL will be much, much better placed. So now comes the final question, that why is now the right time to buy this stock? As per my understanding, aren't the market volatile? Can it still fall? Yes, it can still fall. I'm not arguing about that at all. But right now, the stock seems to be at a sensible valuation as per my understanding. So first and foremost, you will clearly see that this is the main channel that got formed after the 2020 COVID crisis. This is the resistance line. This is the support line. And you can clearly see that the stock has already broken this channel. So it will come back up whenever the situation improves, and it will start trading in this channel again. And there are substantial gains of approximately 14-15% to be made here itself. So that is how I'm looking at it. Do you necessarily need to believe in that? The answer is no. Second key point, it is trading below its 200-day moving average line. This is the 200-day moving average line. This is the second technical indicator that I would say, and it is trading well around 12% from this point as well. And the third key pattern that is getting formed is the cup with a handle pattern, right? So then the technical target almost becomes roughly 24,000 for this stock whenever it undertakes an up move, which is from approximately 17,000 levels, is quite a significant jump, especially if you're a long-term holder in this stock. So I hope you enjoyed the video. Please press the like button, and I will see you tomorrow. And let me know in the comment section, are there other stocks that you would want me to analyze in a similar way? I'll be very happy to do it. The highest number of likes on a particular comment will be an indication for me that I should be making that video. So let me know, and I will see you the next time.